Imagine this, it's 1957. A Soviet bank in Paris quietly deposits US dollars into a London account, not because they love capitalism, but to dodge American spies freezing their assets. That simple move, it sparks a shadow economy worth trillions today, one that powers global trade without a single border guard in sight. Fast forward to now. You're filling up your car, buying imported gadgets, or watching stock markets swing. Behind it all lurks a system most people have never heard of: Eurodollars, not euros, not even European really. These are US dollars living offshore, untethered from Uncle Sam's rules. And right now, in 2026, with trade wars simmering and central banks scrambling, this invisible network isn't just relevant. It's the reason the global economy hasn't ground to a halt. Why does it matter today? Look around. Inflation's biting, supply chains are fragile, and dollars are still the world's go-to currency for everything from oil deals to corporate loans. But the Fed only controls a fraction of those dollars. The rest, they're Eurodollars sloshing through banks in London, Singapore, and the Caymans. They fund half the planet's commerce. Disrupt them and you don't just tweak interest rates, you risk a cascade that echoes 2008's meltdown. Yet here we are, relying on this unregulated beast more than ever. Let's rewind and unpack how this started. Post-World War II, America floods Europe with dollars through the Marshall Plan. Billions pour in to rebuild. European banks end up holding piles of greenbacks. But why keep them in the US, where regulations bite and taxes loom? Enter London. British banks spot an opportunity, accept those dollars, pay a bit more interest than American banks can, and lend them out freely. No Fed oversight, no reserve requirements. It's banking without the handcuffs. By the late 1950s, the term Eurodollar sticks, not because of geography. Dollars in Asia or the Middle East count too, it's any US dollar deposited outside America. Simple, right? But here's where it gets clever. A company in Germany needs dollars to buy American machinery. They borrow from a London bank holding Eurodollars. That bank doesn't ship cash across the Atlantic, it just credits an account. Poof, more dollars circulate without the Fed printing a single bill. Now, step by step, let's see how this machine actually runs. It begins with a deposit. Say a Saudi oil exporter gets paid in dollars for crude. Instead of parking it in New York, they stash it in a Swiss bank. That bank now has a liability, a promise to pay back those dollars, but also an asset to lend. They loan it to a Brazilian firm building a factory. The Brazilian firm deposits those loaned dollars in, say, a Hong Kong bank. That bank lends it out again and again. This is fractional reserve banking on steroids, but offshore. In the US, banks must hold reserves, say 10% of deposits against loans. Eurodollar banks often zero. They create credit from thin air, multiplying the global dollar supply. Estimates peg the Eurodollar market at over $15 trillion today, bigger than the US economy itself. Trillions in loans, swaps, and derivatives built on promises, not paper. But wait, isn't this just efficient? Sure, on a good day, Eurodollars grease the wheels of global trade. They let emerging markets borrow cheaply, corporations hedge risks, and investors chase yields. Without them, international deals would crawl. Think about it, 64% of world debt is in dollars. Most of that flows through this shadow system. It's why your morning coffee from beans shipped across oceans doesn't cost double. Yet here's the uncomfortable math lurking beneath. This isn't infinite money, it's a chain of IOUs, each link depends on trust. In 1973, oil shocks flood the system with petrodollars, OPEC cash recycled into Eurodollar loans to developing countries. Sounds smart, but by the 1980s, defaults ripple through, banks scramble, liquidity dries up. Fast forward to 2008, Eurodollar markets freeze, banks hoard dollars, unwilling to lend even overnight. The Libor rate, the benchmark for these loans, spikes. Suddenly, trillions in funding vanish. The Fed steps in with swap lines, essentially printing dollars for foreign central banks to lend out. Irony alert, the US rescues its own currency from a system it doesn't control. That's the hype versus reality clash. Popular narrative, the dollar's king because America's economy is unbeatable. Sure, but the real dominance comes from this offshore Wild West. We celebrate the Fed's power, yet Eurodollars evade it, creating dollars faster than any printer. Central bankers whisper about shadow money, private banks minting global liquidity. It's absurd. The world's reserve currency thrives because it's not reserved, and the skepticism creeps in. Who watches this? No one really. The Bank for International Settlements tracks it loosely. Regulators in London or Luxembourg nibble at edges, but the system's designed to slip through cracks. It's a global central bank without walls, governors, or accountability. Efficient, yes, fragile, absolutely. Zoom out and the stakes skyrocket. Eurodollars tie nations together in a web of debt. China holds trillions in dollar assets much offshore. Russia sidesteps sanctions via these channels. Climate funds, they flow through here too, but risks mount. Geopolitical tensions could choke flows. A cyber attack on a key bank, chaos, or worse, another pandemic and funding seizes again. We've seen glimpses. In 2022, as rates rose, Eurodollar strains surfaced, spreads widened, whispers of shortages. Today, with AI booms demanding massive capital and trade fragmenting, this system hums louder. But what if trust erodes, banks pull back, credit crunches, economies stall?